Welcome to BWC News. I am Elizabeth. Just 2 days before the U.S. Treasury is expected to be unable to repay the national debt, the U.S. House of Representatives voted to pass the debt ceiling bill with 314 votes in favor and 117 votes against. Thus, the bipartisan battle that lasted for months came to an end, and a potential first U.S. government debt default was temporarily averted. After signing the bill, Biden wrote on social media, "I just signed a bipartisan budget deal to prevent the first-ever debt default. Now we will continue to build the world's strongest economy." Literally, this seems like a remarkable success. But as for how the United States will continue to build the world's strongest economy, people really don't see it. According to the bipartisan agreement, the U.S. government debt ceiling will be suspended until January 1, 2025, to meet the government's borrowing needs before the November 2024 election and to ensure that the next partisan battle over the debt ceiling does not interfere with the presidential election. In exchange, Republicans are asking to limit government spending for the next 2 years by continuing to increase defense spending while cutting other budgets. At the same time, taxes would not increase. Who will be affected by both no tax increases and cuts in government spending other than military spending over the next 2 years? Analysis generally believes that because the U.S. government has taken unrestrained spending measures in recent years to stimulate the economy and employment, non-defense discretionary spending, cliff-type restrictions will inevitably affect the liquidity of financial markets. The U.S. economy is already suffering from the impact of high interest rates to bring new shocks. At the same time, inflation remains high, and the impact of the Fed's interest rate hikes are spreading through the economy, and the consequences of the credit crunch caused by several bank failures since March are still difficult to measure. For the matter of U.S. debt default, as mentioned in previous articles, both parties in the United States are afraid of U.S. debt default, sooner or later will come together. After the debt ceiling issue is resolved, what will follow will be the resumption of debt by the U.S. government and the return of market liquidity, which may bring challenges to the financial sector. Although the debt default crisis has largely passed, financial disaster, but difficult to avoid. Because of the importance of the U.S. national debt, the U.S. elite will not let it default. Each time Congress will agree to raise the debt ceiling for the end, although the process is very intense, but the results are consistent. The U.S. debt ceiling, this headache is solved. The U.S. government borrowing year after year deficit, they pay back the money is also very simple, is to keep borrowing new to pay off the old. Once the debt ceiling is reached, there is no way to continue to borrow new debt, then the old debt problem cannot be solved, so it will face a debt default. The United States historically faced this problem. The solution is also very simple, is that Congress constantly raise the ceiling, so that the U.S. government has enough space to borrow more new debt. Borrowing new debt means printing new money. Printing new money will certainly aggravate inflation, so there is a good reason to raise interest rates, and once the interest rate goes higher, then is not more cannot pay back the money? When the time comes, the new debt ceiling is not arrived at faster. This is a dead-end cycle. According to the current level of interest rates to borrow down, the U.S. government's annual interest to be as high as more than $1 trillion. In 2022, the U.S. revenue is only $4.896 trillion, which means that the interest repayment of the national debt accounted for more than 20% of fiscal spending. This deadly cycle, according to the Americans themselves, means that fiscal control. The debt ceiling agreement was successfully broken in Congress. The risk of default on the U.S. debt was avoided, but it triggered new risks. If the debt ceiling issue is resolved, Yellen will issue a large amount of new debt to replenish the account balance. As mentioned earlier, a large number of short-term issuance of new debt, which means the extraction of funds in circulation on the market, will intensify the pressure on the U.S. financial system. The shadow of the burst of the U.S. small and medium-sized banks has not yet dissipated. The Treasury Department issued high-yield Treasury bills. Bank deposits will accelerate the outflow, resulting in a rise in liquidity pressure on small and medium-sized banks. Fear is contagious, and if the risk of a banking mine rises, it is possible that those small and medium-sized depositors may run collectively to run because of panic, and then this is rather scary. Once widespread fears rise, many businesses will not be able to borrow money, which in turn will lead to the entire market to depression, and Biden's approval rating will decline. The debt ceiling agreement successfully broke through, clearing the way for the Federal Reserve to raise interest rates. Good economic data in May has also boosted the Fed's confidence in whether it needs to raise interest rates further next. However, in the past 13 months, the Fed has raised interest rates by 500 basis points. High interest rates will dampen market consumption to some extent, while the debt ceiling bill will lead to modest spending cuts in 2024, which may dampen economic growth to some extent. This situation, combined with the pressure of the banking sector, some Fed officials urgently for the June rate hike is expected to fire. All eyes will be locked on the Fed Chairman Powell. Not to raise interest rates, stubborn inflation is difficult to meet expectations, and the risk of international capital flight, raise interest rates, the loss of depositors' deposits, bank profitability is also tested, forced by the pressure of the loss of funds. Many banks began to pay higher interest rates to retain depositors. Therefore, the debt ceiling bill passed. Not all will be well. Raising the debt ceiling short-term increase in debt into the market may also cause a relatively large impact on the U.S. financial markets. China increased its holdings of U.S. debt by $20.5 billion in March, when the price of U.S. debt rebounded, leading to an increase in the balance of each country's holdings to $869.3 billion. And in April and May, U.S. bond yields rose again, indicating that prices fell again, and China's holdings of U.S. debt balances are expected to decrease again in the next data releases. And in the long run, the U.S. economic model that relies on debt maintenance will come to an end, and many of the original potential problems will be exposed. The U.S. will then face a more serious dilemma. Whether in the short or long term, this does not have any positive impact on the global economy, so the sale of U.S. debt, de-dollarization process will be in full swing, and this trend is irreversible. As more and more countries sell off their U.S. debt is thrown out, a plunge is inevitable. The process may be long. After all, the dollar is still the dominant currency. The debt ceiling reached an agreement, which only means that the United States to relieve the pressure faced at the moment, but the end of the dollar hegemony collapse cannot be saved. The building will fall but a few days later. It's the end of this video. Thank you for watching. Please subscribe to the channel to support. See you next time.